Welcome to Ekcel Academy's live class for the CS Executive Corporate and Management Accounting. Before we proceed towards the live class, a quick announcement. As you can see on the screen, we Ekcel Academy, we are providing free live classes plus mentorship for the CS Executive students. And this free live classes will be there only for 5 days. That is like a free trial for you guys. So that if at all you're happy with the trial, which you will be, of course, you can buy the course. So that is the option which we are giving to the students. All that you need to do for this is to log into our website excelacademy.com, the links for which is available in the description. Please do check it out. excelacademy.com, go there, register for the CS Executive course. It will be a trial for 5 days. So if you like our classes, you can definitely buy the course for CS Executive. So I would suggest do check it out. No harm in checking it out. So if you like it, then of course you will buy it. So that's the thing. Now that we are done with the announcement, we can directly proceed towards the syllabus. Before that, there are a few other links as well in the description. Please do check them as well, especially the tips to study CS course. So I think that's the first link there in the description. Do check it out. So it's a Google Drive link. And also, if you haven't followed our other channels like Ekcel Academy's Tamil, Telugu, Hindi channels, please do subscribe. If you are comfortable in those languages, you can definitely follow us and the content related to company secretary course as such in your respective languages. And if at all you have any suggestions, please do let us know. And at any point of time, if you have any doubts with respect to whatever we are covering today, please do ask in the chat box. We would be happy to help. So that was the announcement, and now let us straight away get into the syllabus. Okay. Of course, we are looking at corporate and management accounting today. That is the module 2, paper 5. So this is the MCQ pattern of exam, which I'm sure you are already aware of. So let us quickly go through the syllabus first, and then we'll proceed towards the specific topic, that is share capital. We'll be covering only that topic today because we obviously won't be able to cover everything. So this is the brief overview of the syllabus. Here we are. So as you can see, this paper has been divided into 2 different parts. One is the corporate accounting part, which is for 60 marks, and the other one is the management accounting and valuation, which is for 40 marks. So both put together, we have this subject CMA, corporate and management accounting, for 100 marks. So in the corporate accounting chapter, we have various chapters, but we will be looking at this particular chapter today. That is chapter number 3, one of the most important chapters, because unless you understand chapter 3, there is no way you will be able to understand chapter 4 or even chapter 5 for that matter. So I picked chapter 4. Of course, we won't be able to cover everything in chapter 4, only the basics. As far as possible, I will try to cover that. So there are other chapters as well. I'm sure you are aware of the syllabus. I don't want to get into that again. So I would suggest, if you haven't already downloaded the latest study material, please do download the latest one, because the institute keeps revising the study material. So if you have registered, let's say a year ago or maybe a couple of years ago, I would suggest check if there are any significant changes in the study material. If there aren't significant changes, you can only check what are the amendments or changes which the institute has made in the study material. Otherwise, your old study material should be good to go. But nevertheless, you can download. You don't have to pay anything extra for that. Of course, they have given few reference material as well. There are various books which they have mentioned here. These are all fine, but I would still suggest, if at all you would like to check out any additional material apart from the institute material, I would suggest Taxman's book is fine for MCQs, because these are all fine, but this was mentioned, keeping in mind the descriptive nature of the exam back then. So now it is all MCQ type of exam. So I would suggest to practice more and more MCQs, and we'll also see how to mark MCQs within the study material itself. So once you start reading the content in the book, you will realize like what might come as a question in the final exam. There is something which you will only start guessing very soon. Only thing which you need to do is keep on writing, or revising or reading the same thing again and again. So that should not be a big deal. So now let us go to chapter 3 here. Let's see what all we have. We have meaning of shares, Meaning of share capital. I'm just checking the chat. So if at all you have any doubts, please do drop in a chat. I'm monitoring the chat here, so that is easy for me to monitor. So that's the only way also. Anyway, meaning of shares, meaning of share capital, kinds of share capital, classes of preference share, that is also there. Then disclosure of share capital, procedure for issue of shares, most important thing here, terms of issue, issue of shares at par, premium, etc. All those things are there. Issue of shares at discount, which is anyway not there. Calls in advance, interest on calls in advance. Almost every topic here is an important one. So if you understand this practical aspect, because this is largely practical in nature. When I say this, I mean this chapter and even the syllabus as such. The entire syllabus is largely practical in nature. Of course, because they have converted this exam from descriptive to MCQ, now they have to ask few theory questions as well. So that comes with the scheme of examination or type of examination. So we'll be looking at various topics mentioned here, which you can see on the screen. Not all of it, but a few of the important ones. So let me just go to that specific page and let's see what all do we have. Just bear with me for a second. Okay, so we are in this chapter, that is accounting for share capital. So what is that we are supposed to understand? Meaning of share capital, types of shares, we already saw. Accounting procedure, treatment in case of forfeiture, a very important topic, forfeiture as well as reissue of shares. Then nuances of redemption and concept of capital redemption reserve. Okay, and there is also there with respect to preference shares. Then we have ESOP, sweat equity, bonus shares, etc. Bonus, these topics are easy actually compared to the ones here. Then we have buyback, then underwriting and its methods. Very interesting chapter, encompasses too many things with respect to share capital. It will require some amount of time for you to understand what is there and to cover it. So I would suggest don't rush through this chapter when you're preparing for the exam. Otherwise you will probably miss a few things which you may or may not have realized. Satvika says hi. Hi Satvika. Welcome to Excel's live class. Now, meaning of share capital, let us directly get into that. A company raises its capital by issuing its shares to finance and carry out its business. So very basic thing, how does a company raise capital? By issuing shares. If in case of a partnership has only one means of raising capital, that is through partners capital. Whereas in case of a company, what the company can do is one of the biggest advantages over partnership. You can raise money by issuing shares to crores of people. So it's not just one man's money which is involved or few people's money which is involved in the business. If at all by chance the business collapses tomorrow, it's not as if one person will bear the burden. Whereas in case of proprietary concern or partnership, then it would be very difficult for that firm or entity to bear the risk. Whereas in company, the risk is spread far and wide. So that is one of the advantages, and also the limited liability that comes with the entity. In case of company, every shareholder will have a limited liability only to the extent of unpaid amount in share capital. Otherwise, the company will not be required to call upon the shareholder to pay any money in the event of unforeseen circumstances. Let's say the company suddenly faces loss. The company won't be able to ask shareholder to cough up his personal money. Whereas in case of partnership, that is definitely possible. That is why some people prefer company form of business. Of course, now we also have LLP to overcome that unlimited liability aspect in case of partnership. So that is there. Anyway, so now they have given few examples. For example, company ABC Limited, let's assume, has a share capital of 50 lakh, they say. That is the total capital of that company. But that capital is made up of different, or rather number of shares. In this case, they say that 50 lakhs is nothing but 5 lakh shares. 5 lakh shares of rupees 10 each. That means each share is worth only 10. So now if someone has 1000 shares, then their total capital will be worth only 10,000 rupees. If someone has 1 lakh worth of shares, then their total capital in that company would be 10 lakhs. So that is the thing with respect to company, as we already saw. we can subdivide the share capital into number of shares. That is the unique feature of company. We can't do this in case of a partnership, or definitely not possible in case of proprietary concern. Now, meaning of share capital, they say a company raises its capital by issuing its shares to finance and carry out business. We saw already. The memorandum of association, which lays down the foundation of the company, contains the amount of capital with which the company decides to register. That means at the time of inception or at the time of incorporation itself, the promoters usually the promoters decide how much capital the company will have. That is the nominal capital, the registered capital. So then they will also subdivide that into number of shares. Of course, you can increase or decrease the share capital at any point of time later on by amending things. But anyway, so we have Valli Vallu and Sabarish Sankaran as well. Hello to you too. Next, different types of share capital. Predominantly we have equity and preference shares. This is something which you would have studied, I'm sure, in 11th, 12th itself, different forms of businesses. So no harm in revising. Equity share, which is not preference share. That's easy to understand. Now, why is this name preference here? Because they have been given preference. That means they will first get the dividend compared to equity shareholders. Equity shareholders will get later on. First, when the company declares dividend, first it will be given to preference shareholders. So that is one preference which they are getting. So Indumukhi also says hello Indumukhi. And then on the basis of convertibility as well, in preference, of course, we have subdivisions on the basis of dividend and the basis of participation and on the basis of convertibility, different types of preferences. We'll see that later. All these things are fairly obvious. I won't get into obvious things, but you can check it out. Not that it's that difficult to understand. So we have, in case of equity shares, different types of equity shares. Not too many types, but two different types basically, with voting rights. Regular voting rights. When I say regular voting rights, that means if you have one share, you will get one share, one vote. One share and one vote. This is our regular voting or rather equity shares. Then we have DVRs, that is differential shares with differential voting rights. So we have few companies in India, for example, Pantaloon and Tata Motors. They had issued differential shares with differential voting rights. You can check them out later on. There are various articles mentioning what exactly is the procedure with respect to that is issuing shares with differential voting rights. So that's an interesting topic. Not many companies have actually tried that. It's okay, but still an emerging concept. Hopefully in time we will know whether that is actually useful for the shareholder or for the company. Otherwise, we generally have shares with general voting rights. That means one share, one vote. Then different types of preferences. I won't get into the differences between equity and preference. I already mentioned two differences. One is preference shareholders will get preference over equity when it comes to dividend, and also at the time of liquidation. If company has to repay all the capital which it has accepted from equity or preferences, first they will return the money borrowed from the preference shareholders. Then they will return the money to the equity shareholders if at all anything is left. So that is the major difference. That's why they are called as preferential or rather preference shares or preferential shareholders. Then we have disclosure of share capital. Let's see what is what. The different types of share capital basically. First is the registered capital or the nominal capital or the authorized capital, which we already mentioned. Why is this important? Because at the time of incorporation, you'll have to mention while filing the documents with ROC as to what do you think is the registered capital or the nominal capital, the capital which you have in mind. It's not as if you will raise so much of money immediately. Maybe the directors, the promoters, they have thought it fit to have that much amount of money or rather number as capital. So that would be the authorized capital, and also authorized capital is the maximum amount of capital which a company can raise. So if company then later on discovers that this is not sufficient, of course that can be changed. Then we have issued capital. For example, my authorized capital is 50 crores. The company thought it fit to have 50 crores as the upper limit for the authorized capital. But later on, the company realized they don't need 50 crores at all initially. So what they did, they issued only 25 crores. Even in the 25 crores, they realized that maybe you should not ask the shareholders to pay everything now. Maybe first we'll ask them to pay 12.5 crores. After 3 months, we can ask them again to pay the remaining 12.5. So now out of 50 crores, let's say 50 crores is my authorized capital. Out of that, I have only called up 25 crores. Okay, that is the issued capital first. I have only issued 25 crores. Out of that issued, I have only called up 12.5 crores worth of capital. That will be called up capital. And if you have received entire 12.5, then whatever you have called up, that becomes the paid up as well. Those are the different stages of capital and disclosure. And that is what they mentioned there. So again, they have given examples as also. You can check it out later. Procedure for issue of shares. Again, how will anyone know about your company? Of course, one of the most important aspects of a company is you can raise money by issuing shares. But how will you let people know that you actually need money? Of course, you will advertise. That advertisement, in case of company, can be considered as prospectus, wherein you will mention what are the things which you need to, or rather planning to do with the money which you may raise. So that is one thing which you will do with respect to issue of shares. You will invite public to make an offer to you. So when a company issues IPO, it's not an offer, but an invitation to offer. Meaning the company is asking us, let's say the public or institutional investors, to make an offer to them. Then they will decide whether to offer shares to the offerers, whether it is public or institutional investors or anyone else. Then they will decide, because ultimately it is the company's prerogative to issue shares or not. For example, you would have seen recently we had many IPOs. One such IPO, famous IPO, was LIC. Many people actually applied for that IPO. Not all of them got it. The lucky ones actually didn't get it. The unlucky ones got, because the moment it was listed, the share price came down and till date it hasn't recovered. That's a different aspect anyway. The point here is, just because you apply for the shares of the company through IPO, it is no guarantee that you will get the shares, because now you are making an offer to the company saying, I am ready to pay so much money for these many shares. Are you ready to issue shares to us? Then the company will decide whether to issue shares to you or not. So it is company's prerogative. So you are making an offer, they will decide it later on. So first they will invite you to make an offer to them through prospectus and all those things. Okay. So that is there. For consideration, generally the consideration in this case would be cash. The company would want cash. Then of course, you can also issue shares for consideration other than cash. That is something which is not very popular. Now, the most important part here, that is the journal entry part. One small thing here. Now, when the examination was in descriptive nature, obviously you had to remember, or rather understand, I would say, not remember, journal entries. And also you had to remember the format, write the format and all that. Now, obviously, they may not ask journal entries. They can still ask actually. But still, let's assume for a second that they won't ask journal entries. But it is very important for you to understand the flow of accounting here, especially when it comes to issue of share capital, including forfeiture and reissue, because lots of calculations are involved. It's not just journal entries, but arithmetic. Because I have seen the question papers, you can check it out in the institute website. There are questions relating to calculations more than anything else. So those are the kind of questions which they generally prefer when it comes to these chapters. But if you know the procedure as to how to pass the journal entries and how to calculate later on, then calculation becomes very easy. All that you need to do is just calculate the amount mentally or using calculator or whatnot. So that you can do if you know the procedure to pass the entries. If you do not know what to pass, then it will be difficult for you to understand whether to add something or deduct something. So we'll see what exactly I mean when we solve the problems. Then you will know how important it is to understand journal entries. Okay. Now what we have here is when shares are issued at par, and if you have to receive the money from public, what would be the journal entry? Let us look at it here. So let's say a company issues shares. I will assume that a company has issued 50,000 shares. Now out of this 50,000, let's assume for a second that the company received 55,000. No company will ever receive exact number of applications. That is a common thing. Now the problem here is what to do with that excess money which we have received, because we invited applications only for 50,000, whereas we have received applications to the extent of 55,000. Now how do we deal with this? First of all, you will have to record this. What to record? Record how we have received this 55,000. So very simple, we would have received 55,000 on the basis of application money. Let's assume for a second that the company is face value, the shares face value is 10 rupees, and the company also issued it at 10 rupees, meaning the company has not charged any premium. Now what is this premium? It's a very simple concept once again. If the nominal value or the face value of a share is, let's say, 10 rupees, and the company realizes or deems it fit to charge more than that. For instance, in case of Zomato, I think it was listed at 135 or something. Initially, the IPO was for 135, 140, somewhere around that price point. Then in case of LIC, it was around 940 or something. That means a 10 rupee share being sold at 940. A 10 rupee share being sold at 135. In case of Paytm also, a 10 rupee share was sold at 1500. I'm just giving the approximate figure. I may not be quoting accurately the amount which was there in the price band. So anyway, I get you. I'm hoping that you get the gist. Now, what that we need to understand here is the difference between the face value and the issue price. In all the three cases, if the face value was 10, the issue price was 135 or 900 something or 1500. That means there is difference between issue price and the nominal value. So now what is the difference called? The company has charged this much excess in each of those cases, and that is nothing but the premium which the company has charged. The company expects or company thinks that the company is actually worth so much, so they cannot obviously sell 10 rupee shares at 10 rupees itself. So therefore what did they do? They sold it at that much price. So now when that is the case, so the shareholder will have to pay so much money, otherwise they won't be able to get the shares. This is called issue of shares at premium. Now, should company always sell shares at premium? Obviously not, it need not. But if a company sells a share worth rupees 10 rupee at 10 rupees itself, let's say issue price is also 10 rupees. In this case, there is no difference, the difference would be 0. So now what is this 0? 0 is 0, that means there is no premium, but instead the company has issued shares at par. When there is no difference between face value and the issue price, we say par. Whereas in the earlier case, the issue price was greater than the face value. So therefore we say the company has issued shares at premium. Here it is at par. Now there is one more thing wherein, let's say, the face value is greater than, or rather, let me put it this way. Face value is 10 rupees, whereas the company has issued shares at 8 rupees. This was there earlier. When I say earlier, before the 2013 Act came into effect. But in 2013, issue of shares for a price less than the face value is not allowed. Meaning, you cannot issue shares at a discounted price. You will have to issue either at par or at premium. Only two options to the company, and 9 out of 10 times, or rather 99% of the times, companies will issue shares at a premium. Otherwise, it makes no sense financially for companies to issue shares at par. Okay, that is the point. Let's get back to the book here. Now we'll look into various installments in a second. I'm just checking if there is any other aspect which we can cover. So they have mentioned what is what, and this is very important section which you have to remember. Section 52. I think you would study this in company law as well, but anyway. Restriction on application of premium money received. That means there are only 5 purposes for which you can issue or rather use securities premium money. That is the money which you have received over and above the face value. Apart from these 5 reasons or purposes, you cannot utilize securities premium money for anything else. So which are those 5 purposes? Let us quickly go through those. Towards the issue of unissued shares of the company to the members of the company as fully paid bonus shares, meaning if at all you want to issue bonus shares to the company, shareholders, members, you can do. In case of bonus shares, as you might already be aware, there is no exchange of money or money's worth. That means the shareholders need not pay anything for getting bonus shares. Next, in writing off the preliminary expenses of the company, if at all company has incurred any preliminary expenses, the securities premium amount can be issued or rather used towards writing off of that premium on preliminary shares. Next, what else? In writing off the expenses of or the commission paid or discount allowed on any issue of shares or debentures of the company. If at all you incur any expenses with respect to issue of shares, commission paid or discount in case of debentures, which is still allowed by the way, in such cases also you can write it off using the securities premium account. Then in providing for premium payable on redemption of any redeemable preference shares, meaning preference shares at the time of redemption most often will be redeemed at premium, meaning if you have received 100 rupees from the preference shareholders, while making the payment to them you will be paying more than 100. That means you are redeeming at a premium, you are giving it back at a premium. So that is the thing with respect to redemption of preference shareholders. Now where will the money come from? You can use the money lying in securities premium account. That is the point. And lastly, for the purchase of its own shares, meaning buyback under section 68. So these are the only 5 purposes for which you can use securities premium money. For no other reason you can touch that account. Which account? Securities premium account. Okay, that is the point. Again, this is something which I already mentioned. Earlier you could issue shares at a discount, but now because of section 53, which explicitly says you cannot issue shares at a discounted rate. Okay, other than sweat equity shares which is given to employees. Otherwise it has to be either at face value or more than that. That means either at par or at premium. No other option. Okay. Then there are other aspects. Let us quickly go through that. Minimum subscription, they say. What is this minimum subscription now? It is nothing but the minimum amount which needs to be subscribed by the public or institutional investors before the allotment can be made. That means if the company doesn't receive that minimum subscription amount from the applicants or the shareholders, then the company cannot go ahead with the issue. That is something which they have to understand, and they'll have to cancel the issue and then they'll have to return the money from those people it has received the subscription amount. Now that minimum subscription is 90% according to the SEBI guidelines. So that is there. Under subscription, over subscription. Anyway, under subscription is covered also under underwriting. You will study that. Today we won't be able to discuss all that. Now let us go back to that problem and then we'll look at few journal entries, and also later on we'll look at the examination question papers, at least the recent ones, so that we'll get an idea as to what kind of questions the institute might ask in the final exam. Okay, so now let me go back here. So let's say, just give me a second. Now as we were already discussing, a company issued 50,000 shares of rupees 10 each, payable in one installment. Let's assume that means full and final, everything will be paid with the application itself, which is usually the case in reality. Of course, in the textbook we study these type of installment based problems. Even for the exam they may ask such problems, but in reality usually amount will be payable in once installment, usually which will be application. Now we received 55,000 applications. Now the first thing which we need to do is, we cannot obviously pass an entry for issuing prospectus. Why? See, one of the important things with accounting is we can only record business transactions. Issue of prospectus is no doubt a business transaction. But the problem with issue of prospectus is there is no money involved. You issue a prospectus so that others can check what exactly or rather what plans you have as a company to do with the money which you are planning to raise. But there is no exchange of money at that time. You are only inviting them to make an offer. When they make an offer to you, they will make the payment for the first time. So that is where for the first time money changes hands. When you receive money from the applicants, they have not yet become shareholders, by the way. Now it is up to you as a company to decide whether you will allot shares to them or not. Especially when you have a situation like this, wherein you only invited applications for 50,000, but you received more than that, like 55,000 applications. In such a circumstance, we obviously have to see what to do with that excess money. We'll see. Okay, now let us record this. Now when you receive 55,000 applications, you will also receive 10 rupees per application, meaning 55,000 applications into rupees 10 per application. 5,50,000 is the money which you will receive. Now this will obviously get credited to your bank account. So in that case, the entry would be bank account debit. Why should we debit bank account? Because that is the asset to the company, because any amount received will directly go to your bank account, and bank is an asset, and the asset rule says if there is any increase in asset, we will debit it. Of course, I'm sure you know the accounting rules. Let me just quickly go through those. We have 4 categories: asset, liability, income, and expense. If asset increases, we need to debit. If it decreases, we need to credit. If liability increases, we need to credit. If it decreases, we need to debit. Same thing for income: increase credit, decrease debit. Expense, same as asset: increase debit, decrease credit. So these are the 4 golden rules when it comes to accounting. So if you understand and remember this, then you can pass journal entry for any transaction. Now coming back, when you receive money, your bank balance will obviously increase. What is bank balance or bank account to you or as a company? It is nothing but your asset. If asset increases, debit it. So 5.5 lakhs worth of asset has increased, so we will debit bank account. So okay, there is one part of the transaction. Something else should also have happened simultaneously. That is, your liability increases. Why? Because you have received money. But have you given anything in return? Have they received any benefit? Have they received any consideration? Obviously not. Who? The applicants, who have not yet become shareholders, by the way. Therefore, that money which you have received now, that is 5.5 lakhs, at the same time will also become your liability. So what we will do is we'll credit to a separate account called to share application account 5.5 lakhs. That means at the same time your asset as well as your liability both are increasing to the business. We just now saw if liability increases, what should we do? We should credit. Therefore, we credited share application account 5.5 lakhs. Now we have received the money. Of course, excess, some amount excess, 50,000. Now what to do with that 50,000? How did we get 50,000? Very simple. 50,000 was the number of shares which we invited rather applications for 50,000. So we should have ideally received 5 lakh. But we received 5.5 lakhs. So what is the difference between this two? 50,000 excess money which we have received. So that excess money will have to be returned. To whom? To the applicants. That means some of those who actually applied for the shares will never get the shares. Why? Because how can we allot shares more than what we have issued? We have only issued 50,000. We can only issue allot 50,000 shares, not more than that. So what to do with those shares? Like the excess amount of money which we have received towards extra, we will have to return. We issued 50,000 shares, but we received 55,000, or rather applications for 55,000. So the difference here would be 5,000 into per share 10. This would be 50,000 rupees. This is the extra money lying with us, which we have to return. Okay. So how do we return? We'll do one thing. Of course, we will return this, we'll credit their bank account, but in the accounting, while accounting this, what we'll do is we'll club this with the share allotment entry. Meaning, now we have received 5 lakhs, no? We have to allot them shares. This is not the allotment stage as such, but we are allotting them shares. We are giving them some shares. That means our share capital will increase. Until now, we haven't given anything to those applicants. There still are applicants. Now, we are issuing them shares. Worth how much? Worth 5 lakhs. That means your share capital will automatically increase. What is capital to the business? Capital is nothing but a liability. Why? It is the money which the owner has invested, and at some point of time in future, you'll have to return that money to the owner. Until you return that money to the owner, it will always be your liability. It's a different matter altogether whether or not you actually return that money. You may return, you may not return, depends. But you are supposed to return. So until you return, it will be liability. So now what we do is, we'll allot them shares. Whom? These 50,000 applicants, or rather applicants for these 50,000 shares. Okay. So let's see. Share application account debit 5 lakhs, or rather 5.5. Because if you go back, we had credited 5.5 lakhs for share application account liability. Why was this a liability? Because we had not given anything in return to them. Now that we are actually allotting them shares, that liability will come down. Liability, if it comes down, should be debited, says the liability rule. 2. Share capital. So what is share capital? Again, a liability. Or you can simply say capital. Capital also has a separate rule, which is same as liability rule. If it increases credit, if it decreases debit. So liability has increased to the extent of 5 lakhs. And lastly, whatever is the difference, that extra money which we noted here has to be returned to them. When you received money, which account did you debit? You debited bank account because your asset increased. Now that you are returning the money to the shareholder, excess money, your bank balance will decrease. So that means asset is coming down. If asset decreases, what does the asset rule say? It shall be credited. So we'll come back here and credit bank account. This is the entry which you need to pass. See, one thing which you need to understand is you have to understand these entries. There is no way you can by heart. The moment you start by hearting these entries, then you have already lost the plot. There's nothing to by heart here. The whole point of this exercise is for you to calculate amounts so that you can answer the questions in the final exam. Because there is no point in by hearting entries. It's not as if they will ask general entries. Most likely they won't. But If you know the process, if you know what to debit, what to credit, then you will know what to add, what to deduct. This whole debit credit is nothing but, whole accounting is based on single rule of arithmetic. Or rather, the basis for accounting is a single rule in arithmetic. We all know that as well. So in accounting, we say the total of debits should be equal to the total of credits. This is nothing but LHS should be equal to RHS. Everything is based on this, isn't it? So if you understand this much, then you can understand anything in accounts. Of course, what is debit? Debit is nothing but the debit side of account. Left hand side. So debit in accounts means only one thing, left hand side. That's all. Whatever we debit on the left hand. We write it on the left hand side. Credit, right hand. If you look at this journal entry only, you will understand. Look at the item which I have debited, share application. Where have I written? On the left hand side. Which account is credited? Share capital. Where have I written? On the right hand side. Also the amounts you can notice. Whatever is debited, the amount will be on the left hand side. Whatever is credited, the amount will be on the right hand side. So these two things should always match. The total of debits and credits. LHS should always be equal to RHS. Then your accounting is perfect. Okay. Anyway, that is the thing. Let me just check if there are any questions in the chat box. Okay, nothing. Now, moving on. So that is the first thing which we did. What? We received the money. We passed the entry for receipt. Then we allotted them share capital. Now, in this problem, the unique thing was we received everything in one go. There are no installments only. But there will be installments in the problem. Okay, in your problem, they'll definitely insert installments as an adjustment. For example, let me say, let's say, we'll take the same 50,000. No issues. 50,000 shares were issued. The company received applications for 60,000 shares. Okay, and it is payable in installments. The 10 rupees for which the company has issued shares is payable as follows. On application, which is the first installment, rupees 5. On allotment, the second installment, rupees 3. And finally, first and final call, rupees 2. These are the 3 different installments. As I said, in reality, this rarely happens. I think one is Reliance, not for its IPO, but for rights issue had done something of this sort. That is, they had issued shares in installments for rights issue, not for IPO. IPO generally no one issues in installments. At least in the past 10-15 years, I haven't come across any such situation. Okay, check on Google. You can search and see if we have any such instances. Most likely no. Anyway, so now in this case, how many installments are there? Application, allotment, first and final call. But there is one problem as well here. We have issued only 50,000 shares, whereas we have received 60,000 applications. So how do we deal with it? First of all, book the entry for receipt, or rather write down the entry for receipt of application money. 60,000 applications received at the rate of rupees 5 per application. That means every person who subscribed to our company shares paid rupees 5 per share. Likewise, we have received 60,000 subscriptions, or rather subscription to the extent of 60,000 shares. Let us record that first. How? Once again, your bank balance will increase the moment you receive money. So bank balance is nothing but your asset. Bank account debit 60,000 shares into rupees 5. So this will be 3 lakhs to share application account, which is nothing but our liability. This will be increase in asset debit. This will be increase in liability credit. Why is the share application a liability? For the simple reason that we have received money, but we haven't paid anything in return. So until and unless we pay something in return, that will be our liability because we have accepted the money from them. Now, after some time or maybe immediately, you will allot them share capital, but can't allot share capital to the extent of 60,000 shares, but only to the extent of 50,000, the number of shares which we have issued. So let's do that. Share application account debit. While debiting, you will debit entire 3 lakhs because that liability is now decreasing. Okay. 2. Share capital. Now use 50,000. Number of shares which you have issued. Only to that extent you can allot capital into rupees 5. That means 2.5 lakhs. Then what about the excess 50,000 which we have received? That will be returned to the shareholders. That's all. How? By crediting bank account. Asset decreasing. Here liability increasing. That's it. As simple as this. Here you don't have to buy hard stuff. Everything is being understood logically, step by step. So that way you will never ever forget anything. And at the same time, you will not get confused as well. Only thing which you need to remember here is the rules of accounting. That's all. The golden rules: asset, liability, income, expenditure. What happens if they increase or decrease? For example, you already know these two are the balance sheet items and these two are the profit and loss items. Whenever there is a transaction in the business, a financial transaction, either the P&L will get affected or the balance sheet, or sometimes P&L on one hand and balance sheet on the other, and vice versa. So what happens if it decreases or increases? What should we do if asset increases, debit? What should we do if liability increases, credit? Things like that. This is the only thing which you need to by heart in accounts. Rest all is all about understanding. Okay. Next, moving on. Now, we looked at the bank receipt. This stage is called the receipt. Okay. And this stage is called the allotment of share capital or transfer. Next. Now what happened? We asked the public initially to pay only to the extent of 5 rupees per share. That was the first installment, and first installment is called what? Application. The next installment is for rupees 3, and that installment is called what? Allotment. Now, maybe after 2 months you realized that now that we have exhausted that initial 5 rupees per share, let us ask the shareholders to pay the remaining amounts, or rather at least the second installment. Now, in this case, you will first ask them, maybe email or whatnot. You will first notify the shareholders saying, now we need the second installment money. We have exhausted whatever you have paid in the during the application stage. Now you please pay us 3 rupees more. So now the moment you ask them to make the payment, you will have to record the entry. You wouldn't have received, no? As soon as you ask, you will not receive, obviously. You will give them some window, like say 7 days. Within the next 7 days, you are supposed to make the payment. During that time, they will make the payment. Okay. So now, but since a company has to follow accrual system of accounting, wherein we say, as and when money becomes due to you, you record it. As and when money becomes due to you, record it. Or as and when you are supposed to make the payment, record it. That means if someone owes to you, even though they have not yet paid, record it. Or if you owe to someone, even though you may not have paid, record it. This is something which we have to follow in case of a company. This is called accrual system of accounting. This is not compulsory for partnership. This is not compulsory for proprietary concern either. But for company, they will have to do this. You cannot wait till you actually receive the money. You can't do that. As a company, you don't have the choice at all. Okay, whereas the partnership firm or the proprietary concern, they have that choice. Anyway, now the moment you ask them, you record at entry. What is that? Share allotment, which is the second installment. Share allotment account debit to share capital. How much money is due now? Rupees 3 per share. How many shares? 50,000. 50,000 into rupees 3, 1,50,000. Share capital 1,50,000. That's it. So what is share allotment now? For us, it is an asset. Why? We have asked them to make the payment. They have not yet made the payment. Until they make the payment towards this will be our asset. The moment they make the payment towards allotment, this asset will become 0. Then we will credit it. Right now, this is our asset. What about share capital then? It's our liability. Why? Why are we asking them to make the payment? Towards issue of shares. We have issued shares to the extent of only 5 rupees. Now we will issue to you shares worth rupees 3 rupees extra. That means my capital, that means company's capital has increased to that extent now. Earlier it was only 5. Now it is 5 plus 3. That 3 we have to show somewhere. No, we are showing it here. Okay. So now share capital is our liability. Increase in liability, credit it. That's it. Okay. We ask them and they are supposed to pay. We ask them for specific reason towards capital. That also we have recorded. Now your next question would be, how do we record when they actually make the payment? What is the entry which we need to pass? Very simple. How will they make the payment? They will transfer the money. Everything happens through bank transfer only. Online, obviously. That means the moment they pay allotment money, your bank balance automatically increases. Now in this problem, we will assume that you will receive everything. Whatever is due, you will receive fully. So in that case, how do we record the transaction? We'll see. See now, what is due here? 1,50,000. You will receive 1,50,000. Let's look at it. Bank account debit 1,50,000 to share allotment. As simple as this. Nothing else. 1,50,000. We were supposed to receive 150. Now we have received that 150. That means our asset, which is our bank, has increased by 1,50,000. At the same time, this asset which we had created earlier, due entry, amount we were supposed to receive, therefore share allotment was our asset, isn't it? Now that we have received the money, will it still be our asset? Obviously not. It will no longer be our asset. So therefore, decrease in asset shall be credited. That's it. Now we are done with recording of application stage and allotment stage, meaning first installment and second installment. A company can have further installments as well. Second installment, third installment, fourth and final installment, whatnot. But in our case, we have only first and final installment or first and final call. Now, once again, you'll pass the same set of entries. That is first call amount due, meaning after 2 more months. First, let's say in August, you issued the IPO. Only application money received. In October, you requested them to pay the allotment. They paid. Sometime in Jan, you asked them to pay the first and final call. As and when you require money, you will ask them to make the payment. They will make the payment. Now, we are asking them to pay the first and final call. Once again, first and final call due. Share first and final call money. Debit 50,000 shares into rupees 2, 1 lakh to share capital. As I say, same as allotment. 1 lakh. Once you receive this, again, this is the asset which we have created. Increase in asset, increase in liability in this case. cancel that asset. Now that we have received the money, no, will it still be your asset? Obviously not. So bank account debit, because they would have paid money, your bank balance would have increased. So this asset, that is bank, is replacing your this asset, which is share first and final call. 2, share first and final call. 1 lakh. That's it. That's all. What else? Of course, this is a problem without any adjustments as such. We are assuming that everything is hunky-dory here because there are no calls in arrears, there are no calls in advances, there is no interest, there is no forfeiture, there is no reissue. All such things are not here. Obviously, you will have all those things in exam. They will ask you to calculate such things. Here we are not doing all that because it requires a lot of time. For that, what you would be required to do is to enroll for our free trial and use it for 5 days, and then decide whether you like it. And if you like it, you can always continue that, whatever you have enrolled for. Obviously, I wanted to show you something here because this is objective scheme of exam. So this is how your exam paper will be, wherein they will ask questions like this. It will be mostly facts-based exam because they will ask you things and you'll have to remember and answer. But obviously there'll be problems as well. For example, where is the problem? Look at this. X applied for 200 shares of rupees 10 each in ABC Limited, but he was allotted only 160 shares. Even though he applied for 200, he got only 160. After having paid rupees 1 on application, he did not pay the allotment money of rupees 2 per share and first call money of 3 per share. First he paid the application money. Then he did not pay the second installment and the third installment. What would the company do? The company will wait for some time, and finally when they realize that this fellow is not going to pay the second and third installment, why should they wait for him forever? They will cancel his shares. That is called forfeiture. And then what amount will be credited to share allotment account at the time of entry for forfeiture? This is an interesting question. You can easily answer. It's not that difficult. Whatever was not received towards share allotment, that you will credit. It can also be calls in arrears. That is something which you have to understand. All these things are actually explained in our live classes. Please do attend. So, or you can also watch those recorded sessions. There is no doubt about that. So all the live classes are available as recorded sessions as well. So please do sign up for the free trial and mentorship, which will be there for 5 days. After that, if you wish to continue, otherwise no. That is up to you. Okay. So that is the thing. And also, as I said in the beginning, please do click on the link, the first link, which is of the tips to pass CS exam. It's a Google Drive link. You can check it out. So that is also there. And if at all you have any doubts with respect to whatever we covered today, please do leave a comment below. I will try to get back to you. Okay. So these are all available, all these question papers on the institute website. Please do check it out and practice those. As much as you understand the concept, it's also imperative that you practice these type of questions, so that in the exam you'll be able to answer these quickly, because 100 questions are there. It will take time for you to cover everything in the exam. I'm referring there because once you start thinking, you'll lose time. So then it'll be difficult. Anyway, let me end with the announcement once again. Free live classes plus mentorship for these executive students for 5 days. The number is there. You can WhatsApp the number here, 973-973-3400, and the links are there in the description. Please click on the links. You will be taken to the right place. And also, while you are here, please do subscribe to our various other language channels as well, Telugu, Tamil, Hindi, etc., so that you will get updates in those languages if you are comfortable with those languages. So that is something which you can do. I hope this session was helpful. If you found this helpful, please press the like button, and also please do subscribe if you haven't yet subscribed to our channel. And yeah, that's all. Thank you for joining us for the live session. I know we couldn't cover much, but whatever we covered, I hope that was useful, and it will be useful for you in the exam as well. Thank you. See you.